Alrighty. You guys ready?
How do I look? No
You look
problems.
good.
You can't see any beer cans in the back of my screen, right?
No, you are good.
Okay, good.
Welcome, everyone. Hey, Ethan.
Hi,
Hi.
how's it going?
Going good.
Great.
All right. Paul, did you give it a couple minutes before you started, just in case anybody straggled in? Okay.
Just usually about a minute or so, and
Okay.
yeah.
Well, welcome everyone back. Here they come. All right.
You know, I'd like to say for the record, first of all, you guys are killing it. This is all going so smooth so far. I'm real impressed. I know that at this point you're aces with social, with online, like all the virtual tastings and stuff, but you've done a great job here again. Not surprised, but well done.
Thanks, Ethan.
you,
And thanks
Ethan.
for being
The one
on
thing
every
about
one of
the-
these.
Well, it's probably not going to manage to be true all week.
Mhm.
But that was my other point. Although virtual is lame because we don't get to see each other and hang out and drink beers and hug and all those things I miss. It is cool that I can get to every session because none of them are overlapping and I'm not on any of the panels.
Yeah.
That's good.
So thumbs up for that.
Yeah, it is. It's definitely nice like that. You can just sit back and relax, drink your coffee or your beer. Awesome. Well, welcome everybody. My name is Jennifer Myers. I'm with the New York State Brewers Association, along with Kate Van Bramer from Mengel, Metzger, and Barr. Thank you, Kate, so much for being here with us. We appreciate it. Today's session, Accounting Recovery After the Pandemic, it's sponsored by DWS. So thank you to DWS. And I'd also like to make aware that MMB is sponsoring our happy hour this Friday with Spencer Ludwig. So we hope to see you guys all there. We appreciate it. But at this time, if everyone could keep themselves on mute. If they have any questions, please put your questions in chat, and when appropriate, we'll call on you guys to ask your questions. I'm going to put in some links as we go throughout, so make sure you save them and take a look at them. And if you guys can, I'll put in a sign-in sheet if you can just sign in so we can keep track. All right, Kate, I'm going to go ahead and leave it over to you.
Awesome.
Thank you.
Awesome. Thanks for the introduction, Jen. I just wanted to thank Paul and Jen and all of the New York State Brewers Association staff with asking us to present again. We appreciate the opportunity. Mengel, Metzger, Barr has been a proud allied member of the Brewers Association for a number of years, and we look forward to this conference every year. And I look forward to doing it in person again. Ethan, I agree that it's nice to be able to get to every session. And I do have to admit that I'm a little more less hungover than I normally am during this whole conference. So I guess that has the benefit as well. I see Paul agreeing with me. So I'm going to talk about accounting recovery after the pandemic. It has been a tremendous amount of legislation that has come through the pipeline this year. So I'm going to touch on some highlights of that. Want to give you the agenda. Can everyone see the agenda there?
We can, Kate.
There we go. Okay, perfect. So I'm just going to really touch on the highlights of a lot of the program. A lot of it has been in the news, and a lot of it has so many caveats and exceptions and safe harbors that looking at it from a global perspective is really difficult. It's a lot easier to get into the one-on-one conversations as to whether you apply, whether you qualify, what you qualify for, in what order should you qualify, should you use the wages, etc. So I'm going to touch on a lot of things, but happy to have a conversation with anyone that's on the call or or anyone in general that really want to dig deeper into a lot of these topics as they apply specifically to your company or your brewery. So please feel free to reach out. My information is at the end of the presentation. So just an agenda of the stuff that we're going to cover. Biggest thing that probably came out of the CARES provision, which was the act that was passed in March of 2020, was that Paycheck Protection Program loan. So we'll touch on that, a recap of the first draw, an overview of the second draw, which is really what we're in the process of right now. Program reminders, so a lot of the same program reminders apply for both the first and second draw. So we'll talk about those. The employee retention credit, which was also hard to believe, but also a part of the CARES provision. It just got a whole lot more attractive in December when they said you could take that with the PPP money. So we'll talk a little bit about that because it's coming into play now. We'll talk about more information that came out of those two acts that maybe was overlooked because of the first two, the PPP and the employee retention credit. We'll talk about some proposed corporate tax changes that are coming to fruition under the new administration, although nothing has been signed at this point. We'll talk about what's coming down the pipeline, and then a little bit of brewery potpourri, so some stuff that I wanted to cover that I didn't really think fit in any of the other topics. So we'll talk about that. As Jen said, I'm going to stop periodically throughout the presentation. So if you do have any questions, feel free to throw them in the chat, or if we stop and you want to just ask, feel free to do that as well. Okay, so let's just get started. So a recap of the Paycheck Protection Program. So this was a loan designed to keep people working, a loan designed to give an incentive to keep the employers keeping people on their books as employees. Those loans were 100% backed by the SBA, or the Small Business Administration. The initial round launched on the 3rd of April. It was $349 billion. It ran out in about 2 weeks, about 14 days. A second round of an additional $310 billion was allocated on the 24th, and that has been exhausted as well. So certainly a tremendous amount of influx of money coming to small businesses and large businesses to keep people employed during this pandemic. The average loan amount for this program was about $113,000. And that struck me as odd because I feel like a lot of what we heard, especially in the beginning of this, was the large corporations sucking up all of this money. And, you know, you saw NFL teams that were qualifying for this, some of the larger restaurants, that sort of thing. But the average loan size was only 113, and it's actually a little bit smaller has been a little bit smaller for the second round of funding. So keep that in mind. A lot of it is finding its way into the hands of small businesses, which is really what it was put there for in the beginning. The terms of that loan, it was a 2.5 multiplier of the average payroll for the employer to a maximum of $10 million. The loan had a maturity of 5 years, assuming that amount was not forgiven. It was initially 2 years. It had been extended to 5 years pending forgiveness. But some of those earlier loans may still be under the 2-year exemption if they need to be repaid. The interest rate is a fixed 1%. There's no prepayment penalties, no fees, no personal guarantee related to those loans. The second draw, which is the second round of funding that was awarded in December of 2020 at the end of the month, has different stipulations. So this required that the employee has less than 300 employees. And the other caveat is that the employer needs to show a 25% decline in gross revenue, gross receipts quarter over quarter. So that's any 2020 quarter compared to any 2019 quarter. So if we're looking at Q2 of 2020, if you can show gross receipts decline of 25% over Q2 of 2019, you would qualify. Again, this is not an annual test. So if you have the capabilities through your accounting software to look at it quarter by quarter, that's what you should do, because you really just need to hit one of those thresholds. If you don't, you are able to do it on an annual basis, but obviously it's a little more difficult to sustain a 25% decline in gross receipts quarter over quarter, or maybe not, depending on the business. Another stipulation, you need to have received and spent the first draw of the PPP loan. So that initial draw has to be received and that money has to be spent. Now, if you did not receive any of that first round funding, there is a very small amount in the second round pool designated for those first loans. So if for some reason you didn't apply or receive that first round of funding, if it was exhausted by the time you got there, there is an amount designated for that in the second round. So certainly something to keep in mind, not automatically disqualified. I also threw up a definition of the gross receipt. It really follows your method of accounting. I'm assuming most of you are on a cash basis for your tax return, so I would look to see that year over year. If you have audited financial statements, you may be on the accrual basis, but it depends on what your borrower's method is of accounting. It does exclude certain revenue type items, so it doesn't include capital gains or losses. It doesn't include receipts from affiliates. It doesn't include that PPP-1 funding, which is important. So if you did receive that in Q2 of 2020, that is excluded. That's not counted as revenue when you're looking at that decline in revenue. What is the amount? 2.5x monthly payroll costs. Again, the same qualification as that first round, up to a maximum of $2 million of borrowing. So the threshold has been taken down. If you'll recall, it was 10 million the first time. It's 2 million this time. There was the same stipulation of $100,000 of annual compensation limit. So if you have a highly compensated employee that's making over $100,000, their wage can only up to 100,000 of their wage can be counted in this PPP forgiveness or in the application process. So it would be limited, assuming you're applying over for the 24-week period. It's limited to that 20,833, which calculates out to be 2.5 cents of $100,000. Along that same line of thinking, Schedule C borrowers, assuming you don't have any employees, you're also limited to that 2833 number, and that's really based on a maximum net income of $100,000 off your 2019 Schedule C, limited to that 2.5 months percentage. So something to keep in mind. Again, the limit is $100,000, but if you had less of a pocket, let's say you had $50,000 of net income on that Schedule C for 2019, it would be half that amount, it would be 10.4, if that makes sense. Okay. So then how to apply? The application process is now open. It opened mid-January, and it will be open through the end of March 2021 or until the money runs out. This was the same caveat that was in place for the 2020 amounts. The pool of funds that was allocated to this in December is $284 billion. Of that amount, up to last week, about 115 billion has been spoken for. So on the table is at less than 169 billion in the current state. The other thing to keep in mind, and this is actually an exception that was discussed today in the news. So the president has announced that he's going to change the application process for the next 2 weeks. So beginning on Wednesday, the 24th, and for the following 2 weeks, only businesses with less than 20 employees can actually go through the application process for this money. Obviously, there's been no word on what if you're already going through the application process and you're above that threshold. So we will wait and see. But to apply for that process, we're really trying to get money into the hands of those small businesses. So if you are have less than 20 employees, certainly this might be the time to start, looking, because they are specifically looking to fund that type of a business in the next 2 weeks. So closing down the process for those bigger loans, trying to push through some of the smaller loans. Let's see, where is that? Oh, sorry. So if you're using the same lender as the first draw, they may have greased the process a little bit for you, so you may not need to provide the same documentation, which is proof of that 2.5 months of what your annual payroll is. If you are applying for a loan that's over the $150,000, you will need to submit documentation of that decline in revenue during the process of application. If you're less than $150,000 for that loan, you'll need to supply that at the time of forgiveness, not at the time of borrowing. Okay, so the eligible expenses, these have not changed, but they have been enhanced, not the payroll, but the other expenses. So I'll go through these pretty quickly. The first rule, I guess, in PPP funding is that 60% of those forgiveness expenses need to consist of payroll. What does payroll consist of? Compensation to employees, including wages and commissions, cash tips or cash paid to the equivalent of tips if your business is closed, payments for leave, so vacation, parental leave, family leave, sick leave, etc. An allowance for separation or dismissal of an employee, employer paid health insurance premiums, retirement contributions, and state and local wages taxes assessed on wages. What does not count as this 60% is any payments that you have to independent contractors. So think of this as W-2 employees. If you have a 1099 employee that is an independent contractor, that's not an employee of you, that is an employer of their own, and they would need to apply for their own PPP loan. They would not follow, and they would not qualify underneath your PPP loan. You would not qualify for their wages. The other expenses, so this would be the 40% that doesn't make up the payroll. The biggest thing to keep in mind for this is obligations that were in place prior to 2/15. So that's the date that the SBA has put in the sand. And that would be, interest payments on any mortgage obligations on real or personal property. So the difference here would be if you have a mortgage on real estate or you have a debt obligation on equipment, that would be considered real or personal property. If you have interest related to a credit card or something that is not related to real or personal property, that interest doesn't qualify. Payment on rent obligations for real or personal property that were in place prior to February 15th. So this would be, rental space, tap room rental, etc., equipment rent. The interest related to those or the payment related to those is qualified. One frequently asked question that I've had from some of my clients is, what if my lease was renewed after 2/15? So let's say I had a 3-year lease and it renewed on March 1st, that would qualify. So we're talking like new space, but if it's old space that, that lease has just been renewed, that would qualify. And I did mention frequently asked questions. The way that the SBA is really putting out a lot of the information or clarifying these standards because they were, so quickly rushed together, is frequently asked questions. So if there are specific questions, I would reach out to your CPA first. But a lot of those can also be found on those frequently asked questions on the SBA website. So to continue, utility payments for electricity, gas, water, transportation, telephone, internet, et cetera, that were in place prior to that February 15th date again. These are some new expenses that now qualify under that 40%. They were clarified in the December Act. And first one, operating expenses. So any business software or cloud computing services to facilitate operations. Things to think about, accounting systems, POS systems, something to track your sales, something to track inventory. All of those systems are now can be included in this cost. Property damage costs. So any costs from damages due to public disturbances, things, protests, riots, etc., occurring in 2020 that was not covered by insurance. Those also qualify. Supplier costs, so payments to suppliers that are essential to borrowers continuing with current operations. Those now qualify. Worker protection expenditures, so all of the money that you've spent on hand sanitizer, plexiglass for the bars in between table, etc. Anything to become COVID compliant is now qualified under these expenses. So now that you've qualified and we are starting to gather the documentation to prove that forgivability of the loan, a couple of things to consider. What documentation should you collect? This, I think, is probably going to be one of the biggest things related to the PPP is gathering the documentation. The SBA has up to 7 years to audit these loans. Nobody's gone through an audit yet because we all have just gotten to the point of getting to that forgiveness process. So nobody knows what exactly is going to need to be pulled together. So we can only rely on the guidance that's out there. And honestly, I'm advising my clients, more is more. So if you have documentation, put it together, get yourself a packet because you're in that mentality right now and save it for the next 7 years because it's potential to have an audit on this number, and we don't need to be pulling together this information 4 or 5 years down the road. Copies of all interest statements for interest paid on debt obligations, showing that the obligation is there, plus the proof of payment. Bank statements, copies of canceled checks or statements that substantiate the utilities paid for that covered period, and the forgiveness application. So the forgiveness application, and we'll talk about this in a few slides. I'd first contact the lender to make sure that they don't have any specific guidance specific to their institution. The general applications are on the SBA website, but again, I would go through your lender to make sure you've got everything covered. So there are 4 steps to this forgiveness application. Step 1 is calculating the payroll cost for the forgiveness score. As we've talked about, you need to have at least 60% of eligible costs used for payroll. If you have less than 60%, your forgiveness is reduced by that amount that's under the 60%. And I'll go through a quick example of this. Let's assume that the brewer has no decrease in full-time equivalent employees and no decrease of your wages that's greater than 25%. And we'll talk about that again because that's another caveat to this. Your total loan was $100,000. Your payroll for that period, your covered period, was only $50,000. Total other expenses were also $50,000. So in theory, you have $100,000 of expenses, but only 50 instead of 60 is covered by payroll. So we would have to reduce that forgiveness about by the percentage that's not making up that 60%. So your entire forgiveness would only be 83,000. You'd be required to repay the 17,000 which you're essentially leaving on the table. This is less of a concern, I think, now that the covered period is 24 weeks versus in the beginning when it was 8 weeks. So your 2.5 months of payroll, if you think about that, you're looking, that's 10 and a half, 11 weeks of payroll that is that forgiveness amount, that total loan amount. And now you have 24 weeks to spend it. So unless your head count has significantly changed, you're probably not going to have trouble making this 60%. But it is a consideration and certainly something that you want to look into first and foremost. The second step is to calculate any decrease in full-time equivalent employees for that covered period. So if your head count drops by 15%, your forgiveness drops by 15%. Again, there are certainly carve-outs related to this, and we'll talk about those in a minute, but keep in mind, if your full-time equivalent goes down, your loan forgiveness goes down. And here's an example of that. So you have 3 full-time employees in your brewery. They're making $3,000 a month. So your total PPP application is based on 2.5 months of that payroll. So your 22,500 is your total loan. When you lay them off in February, you bring 2/3 of them back. So you bring 2 of them out of the 3 back. You pay them, the total equivalent of your payroll is 36,000, but you've only brought 2 of them back versus the 3 that you had at the beginning. So now your entire loan is not going to be forgiven. Only 2/3 of that loan is going to be forgiven because the full-time equivalent has gone down. Again, there's caveats to that, but we'll talk about those in a minute. The next step is to look if your overall payroll has been reduced by 25%. Again, I think this is probably easiest to tell in an example. We'll use the same example that we used prior. So you've got 3 employees. They are making each $3,000 a month. So you have a total payroll loan amount of 22,500. You've laid them off in February. You brought them all back. So you brought them back at $2,000 per month versus $3,000 per month. So that amount is less than 75% of what they were making, which is the magic number. So they are making 66% versus 75%, which is what they need to make. So again, that loan forgiveness number will be decreased by the amount, by that delta of 75 to 66%. So your total forgiveness will only be 18,000 versus that 22,500. Again, just things to keep in mind. The nice thing about this is step 4. There are certain caveats that we can skip steps 2 and step 3, which is the easiest way because then you don't have to do any of the fancy calculation of full-time equivalents, salaries, etc. A couple of the safe harbors that will kind of get you around this. The easiest one that you restored your full-time equivalents by 12/31. So if you restore your employee level to that pre-pandemic level, you don't have to worry about it. If you are unable to operate at the same level between 2/15/20 and the end of your covered period due to guidelines of the Department of Health and Human Services, the CBC, or OSHA, you also are exempt. So certainly almost everyone on this call probably qualifies because you are unable to conduct business substantially the same as you were prior to the pandemic. There's also exemptions if you have made a good faith to hire an employee and they have said no. If you are unable to find an equivalent employee, or if an employee has been fired with cause, if an employee has asked for a reduction in hours. So these are all caveats that will get you away from that full-time equivalent calculation, but certainly something that you should really look into and kind of talk through with your CPA if you have any specific questions on those. I'm going to go through this a little bit quickly because I feel like we've talked a lot about kind of the documentation thing, but again, I think it's super important to keep in mind, you know, this information is fresh in your mind right now. So the time to document and make sure that you have all of your ducks in a row is right now. Even if you don't need to submit for the application, these loans still have potential to be audited. So make sure that you have, you know, copies of your payroll tax reports, copies of those payroll reports for the wages that you're using to cover, documentation of the health insurance premiums that you've paid, documentation of any retirement plan contributions, and any of those lease obligations, and payments of the interest related to those. So just really make sure that you have all of that information gathered at this point, and put away for the next 7 years so that we don't have to, you know, try to be pulling together this information down the line. So now that you've gotten to the point of you've got all your information in front of you, the question is, what application do you submit? And it's one of three. The all-encompassing one is that Form 3508. I would only fill out the 3508 if I didn't qualify for one of the other two examples. The SBA has come out with the 3508 EZ, which I would say is the medium return, the medium form in difficulty, and the 3508S, which is simplified. The 3508S is a 2-page forgiveness application, and it is not affected by the FTE or salary reduction calculations which we just talked about. So if your loan is less than $150,000, you don't have to run through any of those calculations. You do need to keep all of your information, but you don't need to submit it with the forgiveness. It's a 2-page, quick and dirty forgiveness application. The 3508 EZ, which again is kind of a medium, you can use this if you are self-employed or have no employees, or if you have not reduced your FTE equivalent, haven't reduced the wages more than 25%, or you qualify for one of those safe harbor calculations. So if you do need to do any of those, you don't qualify for the safe harbor exemptions, and you do have a reduction in either the FTE or in the salaries, wages, etc., then you need to use the 3508, which is a more difficult forgiveness application. Also related, a couple of points that I wanted to make for this forgiveness application. So when everyone applied for the PPP back in March, I know there's an onslaught of those applications going in. One of the questions was a good faith question, and it asked the applicants that they need that money to continue the business. Was this loan, sorry, did you need that $2 million to continue your business? And of course, everyone checked yes, because nobody knew what was going to happen in 2020. So the one thing to keep in mind is you really have to document, you know, that good faith safe harbor, did you need a loan? That question, you don't need to consider, you know, the hindsight is 2020. And at this point, maybe some businesses did, maybe some businesses didn't. but that question was asked on the application process. So loans over $2 million at this point will need to quantify that with the forgiveness applications. Loans less than $2 million are automatically deemed to have made this requirement certification in good faith. So you don't have to prove that you needed the money under $2 million. But again, I would document that because we haven't been through this process before, and I think the documentation is going to be key here. In terms of the forgiveness, you need to apply for forgiveness within 10 months of the end of the loan period being used. And then from that application date, the SBA and your lender have 150 days, 60 days with the lender, 90 days with the SBA themselves to get back to you in terms of forgiveness. What we've practically been seeing in the last few months is that these smaller loans have been coming through for forgiveness very quickly. We have not seen a tremendous or any of our loans over $2 million come back with that forgiveness calculation being fully forgiven. So the SBA is certainly taking their time with this for a few reasons. I think because the second round is coming out and they're overwhelmed with that at this point, and they're asking for more information in that round. So they're trying to process this on two fronts, and they really want to take their time with those larger loans. So we've seen a lot of the less than 150 or that 150 to $2 million loan coming back and being fully forgiven. But they're certainly delayed with those over $2 million big loans. So to be seen on how long that forgiveness application process is going to take. It should take 150 days. I think it's probably going to be further extended than that. So that's the first half of the presentation. A lot of information on the PPP. Are there any specific questions on that?
Yes, Kate, you had a question from Erica. Erica, do you want to go ahead and ask your question?
Yeah, sure. So we received the first round PPP loan, and we're on track to be forgiven, and we've got our paperwork in order for when the documents are released and all that good stuff. But it really hasn't been clear as to how we should be documenting that money in QuickBooks. So I asked the bank about that. They referred me to my accountant, and then I talked to our accountant and he referred me to the bank. So I'm like, great. So nobody, and Pursuit is the one that we got our loan through, and they're one of the big lenders. So I was shocked that they didn't have any more information on that. So I'm wondering if you have any insight as to how we should, I mean, do we just, I'd find it really weird to not record it.
Yeah, don't not record it, because then your cash isn't going to balance.
Right.
And that will create a whole nother issue.
Right.
I would record it as like an other income. And that brings up a good point, and one that I assume that everybody has determined at this point, but those expenses are deductible for tax purposes. So in the beginning of all of this, we had questions of, should I, if I'm using it for payroll, should I be backing out that number from my payroll? Should I be crediting the expense? Don't do any of that. I would put it in an other income line on your QuickBooks, and that will be not taxable income for your income tax purposes. So your accountant will know that that's not taxable, but it gets a little bit more screwed up if you try to back it out of the expense bucket that you claimed it for. So don't do any of that, especially now that it's tax deductible. So you should just record it certainly as an other income line and make it very clear PPP loan. That brings up another point. We've had a lot of clients that in the beginning there was questions, should I put this in a separate cash account? Certainly not wrong to put it in another cash account, but then you get into, taking transfers from your operating or your payroll into this cash account as you're paying it off. That's certainly not necessary. Some people are recommending that as a matter of best practices, but I think as long as you can document that you've spent the money on the appropriate things, no need to segregate it like that.
Awesome. Thank you, Kate. Any other questions before she moves on?
Okay. So now we're going to get into the employee retention credit, which was kind of the redheaded stepchild until December. So I say that because in the beginning of this pandemic in March, it was an either or. You could take the PPP loan or you could take the ERC, the employee retention credit, but you couldn't take both. And the PPP money was free money, and a lot of people were getting qualified. So a lot of people just put their pencils down and said, you know, I'm going to take the PPP loan. It's easier. I'm going to, you know, not worry about that. So this was also signed into law in March, potential of a $5,000 credit per employee for the 2020 year. And that's really calculated as a 50% credit of up to $10,000 per employee wages. So 50% of those wages gets you to the $5,000. The wages paid for 3/13 through the end of the year. And this credit defined eligible employees as ones that carried on the creator business during the calendar year 2020 and had fully or partially suspended operations due to government orders or a 50% reduction in quarterly gross receipts. There's a distinction between a large employee and a small employee. So in accordance to this wage and this credit, and these numbers have been all over the board. So it's funny to see a small employer being considered 100 and 500 in the next slide, but that's the definition for this credit. 100 employees, and if you are less than 100 employees, the qualified wages are all wages paid to those employees. The caveat is if you were larger, you were a large employer, which has more than 100 employees, those qualified wages are really wages paid for time where your employee is not able to perform the service. So if you were paying someone to keep them on the books, but they were unable to perform their duty for whatever reason, and you were essentially paying them to not work, that's when those wages came into play. Or if they were working at a reduced capacity, you know, maybe they were working 20 hours a week versus and you're paying them for 40 because they couldn't do half their job, those wages would count. But I'm guessing the majority of this call has less than 100 employees, and therefore 100% of the wages qualify for this quarter if you can prove that you're an eligible employer. And again, probably haven't heard about this. A tremendous amount until December allowed you to utilize the ERC as well as the PPP loan. The credit was also extended. So originally it was going to end on 12/31. It was extended through the first 2 quarters of 2020, and they made it certainly even more attractive. So it's gone up to a potential of $14,000 per employee, and that's calculated based on a 70% credit in 2021 on wages up to 10 grand per quarter. So 2 quarters can be claimed, 7 grand a quarter, getting us to the 14. Again, same definition for fully or partially suspended operation, but they have lowered the threshold of the gross receipts decline to 20%, which certainly makes this much more achievable for a lot of employees or a lot of employers who can show that decline of 20% versus 50% that was required in 2020. This can be taken in conjunction with a PPP loan. I say that sparingly because you can't use the same wages. And that's really important to keep in mind. We'll talk about this a little bit more, but if you are using, employee A's wages for the PPP for this segment of their time, for, these months, these weeks, these days, you can't then double dip and also use them on the employer retention credit. So there's a lot of interplay, a lot of conversations that probably should take place, a lot of planning in terms of utilizing, the first $10,000 of wages, utilize the ERC credit, and then you'll still have certainly enough wages, hopefully, to cover the 60% requirement for the PPP. But there's a lot of interplay on that, and not a tremendous amount of guidance. So we're waiting impatiently for that additional guidance on how that ordering should be. Kind of advising clients at this point, take the ERC first, get to the $10,000. There's probably going to be enough wages on the table during your 24-week period to then take PPP against those wages to get you to 60%. But certainly something to look into and make sure you have a good handle on what wages are getting used for which credit. This slide is really just a recap. You can see how much richer the credit program became in 2021. They also, and I'm not positive that I reiterated this, they increased the headcount threshold. So a small employer is now considered having less than 500 employees versus having less than 100 employees in 2020. And again, it can be used with a PPP loan that is retroactive. So if you had made the decision in 2020 that it didn't make sense for you to apply for the ERC wages, if it didn't make sense to apply for the ERC credit, it might at this point, because that's additional money on the table. So certainly something to keep in mind. Steps to getting to this. So we'll talk about determining the eligibility and if you're an eligible employer, how to quantify that credit, and how to claim the credit. First, the definition of an eligible employer. Full or partial suspension of operations. So I think on this call, everyone could make that argument that you've had full or partial suspension of operations, or a significant decline in gross receipts, the 50% in 2020, 20% in 2021. These are just some considerations for what is that reduction. What does that full or partial suspension of operations mean? Workplace closure, is all or part of your workplace closed? Have there been any elements of your business that have been discontinued? So if you're able to do curbside pickup, that doesn't mean, your entire business is still intact. There's limitations on how many people you can have in your tap rooms, how many feet apart the tables have to be. All of that comes into consideration. Restriction on hours, a number of employees, suspension of suppliers or buyers. So for the most part, I think everyone probably can make the argument that your business has been disrupted and there's been a suspension of your operations. The decline in gross receipts is the easiest test to quantify, I think. So I would look here first. If you qualify under one of these, then you automatically qualify. You don't have to justify that your operations have been disturbed. And this is really just a comparison. For 2020, it's a comparison of your quarter in 2020 versus your quarter in 2019. Your eligibility begins the first calendar quarter when your revenues have declined 50%. So let's say, that Q2 in April, when everybody was closed, your revenues went down below 50%. If your revenues haven't come back up above 80% or close to 80%, you probably qualify for the entire year. Again, in 2020, that's only $5,000 per employee. So keep that in mind. You probably are going to hit the threshold for the 2020 year end. In 2021, that's the threshold has been lowered for gross receipts to 20%. And you're going to compare the first quarter of 2021 to the first quarter of 2019. If you can hit that 20% decline in gross receipts, then you qualify. There's also an alternative rule that you can compare the prior quarters. So if you, for the first quarter of 2021, you can compare fourth quarter of 2020 to fourth quarter of 2019. And this is really because it's based on, you know, the refund is coming on payroll taxes. So they want you to know if you're going, the government wants you to be able to tell, are you going to qualify for this prior to the quarter that you're in? So that's really the reason for the alternative rule there. Okay. So then how to quantify the credits? Step 2, if you're less than 100 employees for 2021 or 500 employees for, I'm sorry, if you're less than 100 employees for 2020 or 500 for 2021, then all wages qualify. Again, you really have to be careful not to double dip here. So you can't quantify the ERC credit with wages that you're using to quantify the PPP application or any other federal tax credits. I know that we've talked in the past at this conference about other federal credits that you may qualify for. The one I'm thinking of is research and development. You can't double dip. You can't use those wages to then qualify for the R&D tax credit, but it might not make sense this year. So that's, you know, certainly a question or conversation that you should have with your CPA as to what wages you're going to use to qualify for what program. Just kind of a balancing that. The other thing, and I put this on this slide because I think there's a lot of family businesses in this industry. So eligible wages generated by an individual employer hiring his or her family are not eligible. And the definition includes children, brothers and sisters, fathers and mothers, nieces and nephews, aunts and uncles, in-laws, etc. So if there's a family element to this business, certainly something also to keep in mind when you're looking at what wages qualify. How to claim the credit, it's on the payroll tax return. So the 941, which at this point, I'm assuming everyone has filed. They would do at the beginning of this month or even the last quarter of 2020. So you would have needed to claim that amount on the 941. If you haven't, those can certainly be amended. The nice thing about tax returns is that nothing is ever permanent. We can always go back and amend, and you can file a 941X to amend for that tax return and claim this credit in 2020. So if you had, you know, pushed it aside because you were applying for the PPP loan and now it's back on the table, you can take this credit and apply for, have the payroll company that you're utilizing apply or file a 941X and reclaim some of this money. You'll also probably hear talk about a Form 7200, which is a form that they came up with, which gives you the ability to, instead of rolling forward that credit to subsequently filed tax returns, or, you know, at some point rolling that number forward, you can apply for a credit and they'll actually pay you the difference. Now, the only caveat to that is the 7200 has to be filed prior to the 941, which at this point, again, you probably filed your 941s for those periods. So you will need to amend the 941 or file a 941X, but it might be worth it, I think, in a lot of situations, and certainly something to keep in mind in the 2021 year. So a lot of information. I was going to talk a little bit about some of the other caveats that came out of these acts, but John, are there any specific questions on the ERC?
I don't see any in chat. Do you guys have any questions? You go ahead and unmute yourself. No? Okay. Just so you know, Kate, we have about 10 more minutes.
Oh, excellent. Like a typical accountant, I'm just going to keep talking right over that deadline. I'm just kidding. I'll wrap it up. So just another change that came out, and I think probably got overshadowed by one of the first two credits that we talked about. There was a change to the NOL provision, or net operating losses, for the non-accountants in the room. So just to remind you, if you have a loss in a year, you create an NOL, which can be carried forward to offset future income. So let's say in 2019, you have a loss, you would have been able to generate that to offset future income. Now, prior to 2017, you were able to carry that back. So if you had generated a loss in 2018, but you had paid tax in 2017, you could carry that backwards. The Tax Cuts and Jobs Act, which seems like a million years ago, but it was only 3 years ago, required us to carry those forward. They stopped the carry back provision. The March 2020 Act allowed us to start carrying this backwards for 5 years for any NOLs that were created 2018 to 2020. So let me put this into English for you. If you created a loss that was incurred and created in 2018 to 2020, but you had taxable income in one of the previous 5 years, you're allowed to carry back that loss instead of just carrying it forward. You have to make an election, but you're allowed to carry it backwards. So if you, let's say, paid tax in one of those years, 2016, 17, one of those years, you're allowed to carry this back up to 5 years and get the tax back that you paid. Now, in every situation, you may not want to do this. Something to consider is that, you know, we are anticipating that the new administration will be raising those corporate tax rates. So if you anticipate making money in the coming years or having taxable net income, you may not want to carry that backwards because you'd be carrying it back to a year where you paid a lower tax rate if the tax rate goes up. So just something to keep in mind, something that maybe mention to your accountant or your accountant should be mentioning to you is, you know, what does your business look like? Does it make sense to carry it backwards and try to get some of those refunds? Or does it make sense to carry that NOL forward and try to offset taxable income in the future years when it's going to be taxed at a higher rate? There was also a deferral of the payroll taxes. I'm kind of going to skip this because this really just kept the money in your pockets, but it's still due. So if you did defer any payroll taxes from 2020, 50% of the tax is going to be due at the end of this year. 50% of the tax is now going to be due at the end of 2022. But again, that's really just a cash timing difference of when you have to make those payments. They've also extended the additional unemployment benefit, that additional $300 a week that's been extended through the March 14th. We anticipate that that's going to be extended again, but it hasn't been at this point. We talked a little bit about the Biden proposals. You know, we're anticipating that the corporate tax rate is going to go up to 28% versus the flat rate 21% that it is now. We're anticipating that that top level of individual tax bracket is going to go up from 37 to 39.5%. There's going to be changes to additional wages that are going to be incurred on the Social Security tax. Changes to the PBI deduction, which was a new deduction that came about in that Tax Cuts and Jobs Act of 2017, and changes to retirement. This is all preliminary, so nothing has been set in stone, nothing's been passed, but just to make you aware of some additional changes that might come. And now my salute to Alex Quebec, some brewery potpourri that didn't really fit in anywhere else, so I figured I'd throw it in at the end. due to, a tremendous amount of lobbying and legislative efforts, the federal excise tax levels have been made permanent. So this has been a stone that has been kicked down the road for, Paul, you can probably correct me, but I think at least 4 or 5 or 6 years, 5.
5, yes, 5, 6 years. Yep.
Yeah, so we have been waiting for this to become permanent, and it was made permanent in December. So thank you, lobbyists, when you see them. Another change that occurred, the MT 456, which is the New York State alcoholic beverage tax return that replaced the MT 50. You're able to do that online now. You can also still do it in paper format. And a couple other lobbying things that are kind of in the pipeline, but nothing's been passed yet. There is a new Restaurants Act, which is a $25 billion grant program aimed at restaurants, but the National Brewers Association and the New York State Brewers Association have been advocating for breweries and tap rooms to be included in this. And they've also been advocating for a change to that PPP amount. So we mentioned back in the beginning of the presentation, if your NAICS code, which is an industry code, starts with 72, which is restaurants and hotels for the most part, you're able to take a loan of 3.5 times your monthly payroll. Everyone else gets 2.5 times. And there's been a tremendous amount of lobbying to include breweries and tap rooms in that 3.5%, making the argument that, you're doing the same thing. The problem is that you mostly file under the NAICS code of the manufacturer. So some controversy as to whether that should be included or not, but certainly people are advocating on your behalf to get you included in that number. So stay tuned with that, and if you are included, certainly let you know. And that's it. That's my my presentation, and my contact information is at the end. So please feel free. Again, I know we've covered a tremendous amount of information on these slides. A lot of it is really specific, and I would be happy to kind of talk this through with any of you. So feel free to give me a call or shoot me an email, and we'll set something up.
Thank you, Kate, very much.
Absolutely.
Before we sign off, we do have a couple minutes. If we have any last minute questions, Kate can answer for you. You guys can go ahead and unmute yourself. But I want to say thank you again, Kate. Thank you, MMB. And thank you to our sponsor for today, DWS. If you guys don't mind, please subscribe to the NYSBA YouTube channel to access all the recordings for everyday sessions, which I'll post in the chat. And please join us Friday for our happy hours. It's also presented by MMB, so we really appreciate it. But before we sign off, any other questions, guys? No? Awesome. Thank you, Chloe, for posting that. Well, thank you again, guys. Thank you, Kate. Everyone have a great rest of your day.
Awesome. Thank you.